Have you ever wondered how war, inflation, and gold prices are intertwined in our global economy? Let's take a deep dive into this complex relationship. During periods of uncertainty or international conflict, investors often gravitate towards safe assets to protect their value. Gold, with its enduring value and scarcity, often plays the role of this safe asset. Thus, when conflicts arise or war fears loom, the price of gold typically sees an uptick. This is because gold is often viewed as a safe haven during times of instability and risk. Now let's bring inflation into the mix. In an environment where inflation rates are high, individuals may begin to lose faith in their national currency. When the value of paper money is in question, people naturally seek out tangible assets that hold their value over time. Once again, gold comes into play. As more people turn to gold as a hedge against inflation, its price increases. But it's not just about war and inflation. The price of gold is also influenced by a variety of other factors, including supply and demand dynamics, central bank policies, and even global geopolitical tensions. For instance, consider the aftermath of the COVID-19 pandemic. As the Federal Reserve battled inflation, it consistently raised interest rates to draw money back into the economy. As a result, the inflation rate in the United States saw significant improvement. However, the consumer price index in the first 3 months of 2024 was consistently higher than forecasted, suggesting that the Federal Reserve may have to delay interest rate cuts later in the year. Inflation continues to be a difficult problem, especially in the context of escalating political conflicts. So, as we can see, the dynamics of war, inflation, and gold are not just random occurrences, but are closely linked to each other. Understanding these relationships can provide valuable insights for investors and policymakers alike. But how does the Federal Reserve fit into this picture? Well, the Federal Reserve, or the Fed as it's commonly known, plays a significant role in controlling inflation by managing interest rates. In the aftermath of the COVID-19 pandemic, the Fed has been continuously raising interest rates in an effort to curb inflation. By making borrowing more expensive, the Fed slows down economic activity, which in turn helps to keep inflation in check. However, the economic landscape is ever-changing and sometimes unpredictable. The first quarter of 2024 has thrown a curveball, with the Consumer Price Index, or CPI, coming in higher than anticipated. The CPI is a measure of the average change over time in the prices paid by urban consumers for a basket of consumer goods and services, and it's one of the key indicators of inflation. This unexpected surge in the CPI has led to speculation that the Fed might need to delay its planned interest rate cuts. The Fed's aim to keep inflation under control is a delicate balancing act, and it's constantly adjusting its strategies in response to the latest economic data. If inflation is higher than expected, the Fed might hold off on reducing interest rates, as doing so could potentially fuel inflation even further. So how does this all tie back to gold? Well, the price of gold is often seen as a barometer of inflation. When inflation rises, investors tend to flock to gold as a safe haven asset. So if the Fed's actions lead to higher inflation, this could drive up the price of gold. Conversely, if the Fed is successful in keeping inflation under control, this could put downward pressure on gold prices. Thus, the role of the Federal Reserve is crucial in managing inflation, which in turn affects gold prices. The Fed's actions can have far-reaching impacts on the economy and on your investments, so it's always a good idea to keep an eye on what it's doing. But what happens when political tensions rise? Well, let's take a journey back to the year 2022, when tensions between Russia and Ukraine reached a fever pitch. As the conflict escalated, the world saw a remarkable phenomenon. Gold prices shot through the roof, crossing the threshold of $1,900 per ounce. Why did this happen? Well, in times of international uncertainty or conflict, investors typically seek safe assets like gold to protect their wealth. As a result, gold prices often surge when there are conflicts or fears of war. This is because gold is often seen as a safe haven during periods of instability and risk. Fast forward a little and we find ourselves in the midst of another conflict, this time between Iran and Israel. This conflict saw gold prices skyrocket again, this time surpassing the $2,400 mark per ounce, reaching an all-time high. Historically, conflicts in the Middle East have been closely tied to global oil crises, which in turn lead to economic crises and a rise in gold prices. The Middle East is a strategic point of connection for 3 continents: Asia, Europe, and Africa. Hence, any disruption in this region due to political conflicts can quickly have global repercussions. If the political and military tensions between Iran and Israel continue to escalate, it could lead to political instability throughout the entire Middle East region. This could serve as a powerful catalyst for gold prices to continue their upward trend. On the other hand, it's not just conflicts that can influence gold prices. The actions of central banks also play a significant role. Over the past 2 years, central banks have been on a gold buying spree, purchasing a record amount of this precious metal. For example, in just January of 2024, central banks around the globe bought a net total of 39 tons of gold. The Central Bank of Turkey now holds 552 tons of gold in reserves, only 6% less than its record of 587 tons recorded in February 2023. The People's Bank of China has been on a gold buying spree for 15 consecutive months, and now holds 2,245 tons of gold, more than 300 tons more than in October 2022. In 2023, central banks worldwide bought a net total of 1,037 tons of gold, just shy of the record set in 2022. As we can see, political conflicts, economic instability, and central bank activity all play a major role in influencing oil and gold prices. And as history has shown, political conflicts can significantly impact oil and gold prices. And what about the role of central banks in all this? These financial powerhouses have been buying gold in record amounts over the past 2 years and show no signs of stopping. But why is this? Well, gold is considered a safe haven asset, a kind of financial insurance policy. When the economic seas get choppy, central banks, much like individual investors, flock to the stability and reliability of gold. This has been especially true following the global pandemic, as central banks sought to bolster their reserves and mitigate the economic uncertainty. Their gold buying sprees have significantly bolstered gold prices, even in the face of high interest rates and a strengthening US dollar. Take, for instance, the World Gold Council data from the start of this year. It revealed that central banks across the globe had net purchased a whopping 39 metric tons of gold in just the first month of 2024. Turkey's central bank currently holds a gold reserve of 552 metric tons, trailing by just 6% from their record high of 587 metric tons in February 2023. China's central bank, the People's Bank of China, has been on a gold buying streak for 15 consecutive months, and now holds 2,245 metric tons of gold. That's an increase of over 300 metric tons from late October 2022. In 2023 alone, central banks worldwide net purchased 1,037 metric tons of gold, barely trailing the record set in 2022. The Central Bank of Poland was the second largest gold buyer last year, purchasing 130 metric tons, only surpassed by the People's Bank of China's 225 metric tons. The Monetary Authority of Singapore was the third largest buyer, with a purchase of 76.5 metric tons. These figures underscore the significant role central banks play in the gold market. Their actions, driven by a desire for stability and a hedge against uncertainty, continue to underpin the strength of gold prices. So, the actions of central banks also play a significant role in the dynamics of gold prices. So what does all this mean for the future of gold prices? Well, when we take into account the global economy, political conflicts, inflation, and the actions of central banks, we start to get a clearer picture. Gold, historically seen as a safe haven, is still on an upward trend in the long run. It has weathered storms of economic instability, political tensions, and inflation spikes. And while it's true that central banks have been buying gold in record amounts, it's also important to remember that individual investors play a part in the gold market too. There will be times when they decide to adjust their holdings, leading to periods of price adjustment. But these are just temporary moments in gold's long-term upward journey. In conclusion, the global economy, political conflicts, inflation, and central bank actions all play a role in shaping the complex relationship between war, inflation, and gold prices.